Welcome to the deep dive. We're tackling something pretty fundamental to financial life in the U.S., your credit score.
Yeah, that three-digit number, it has a surprisingly wide reach, you know?
It really does, influencing everything from loan interest rates to, like, even renting an apartment sometimes.
Absolutely.
So our goal in this deep dive is to really unpack credit scores, credit utilization, those sometimes confusing credit reports.
And the credit bureaus behind them.
Exactly.
Hmm.
Think of this as your guide to understanding how to take real control of your financial future.
And it's not just abstract. To show why this really hits home, maybe think about someone like Lisa, a school teacher from Ohio.
Okay.
You'd think she'd have things sorted, right? But when she went to get a car loan, the interest rate they offered was, well, much higher than she expected.
Ouch. What was going on?
Turned out to be a couple of things. First, her credit card balances were kind of high compared to her limits. That's the utilization piece we'll get into.
Right.
And second, there was a medical bill she didn't even know about that had gone to collections.
Wow. So she was completely unaware.
Totally. And Lisa's situation, it's not that unusual, actually. Lots of people don't realize what's affecting their credit until, they need a loan or something.
But the key part of her story, the empowering part, is what she did next, right?
Exactly. Once Lisa kind of figured out, okay, I need to check my credit report, and understood how that utilization thing was working, she took action.
Like what?
Well, she paid down those card balances. She disputed that incorrect collection notice.
Okay.
And over the next year or so, her score really jumped up significantly.
Yeah, that's great.
Yeah. So the next time she needed a loan, boom, much better interest rate, saved her quite a bit of money in the long run.
It's a perfect example, really. A little knowledge and action puts you back in control, puts you in the driver's seat, financially speaking. So let's start right at the beginning. What is a credit score, fundamentally?
Okay, yeah. Let's break it down. This three-digit number we always hear about, what's the real deal? So at its core, a credit score is just a three-digit number, usually runs between 300 and 850.
Right, 300 to 850.
And lenders use it to get a quick read on how likely you are to pay back money you borrow. It's kind of like a financial trust gauge.
So a higher number equals more trustworthy in their eyes.
Precisely. A higher score tells them you've got a history of managing credit well, and that often translates to better loan terms.
Like lower interest rates, better credit card offers, that kind of...
Exactly. All the good stuff.
Okay, now, what actually goes into that score? What makes it go up or down?
Right. So the exact formulas, they're like proprietary secrets,
Kept under lock and key.
Pretty much. But the main ingredients and roughly how much they matter, that's pretty well understood, which is good because it tells us what we can actually focus on.
Okay, what's the biggest piece then?
The most significant factor, making up about 35% of your score, give or take, is your payment history.
Makes sense. Paying your bills on time. Seems basic but crucial.
It absolutely is. Honestly, even one payment that's, say, 30 days late can start to drag your score down. Consistent on-time payments are really the foundation.
The bedrock. Okay, 35% payment history. What's next?
Next up, accounting for about 30%, is something called credit utilization.
Ah, the one you mentioned with Lisa.
That's the one. We're going to dive deeper into that in just a bit because it's really important.
Okay, sounds good. So that's how much of your available credit you're actually using at any given time.
You got it. After that, the length of your credit history comes in at around 15%.
How long you've been using credit.
Yeah. Lenders generally like to see a longer track record of you managing credit responsibly. Think of it like a financial resume. The longer and better it is, the better you look.
Okay, 15%. What else?
Then you've got the types of credit you use or your credit mix. That's about 10%.
Mix, like having different kinds of accounts.
Exactly. Having a mix, maybe some credit cards, an installment loan, like a car loan or student loan, perhaps a mortgage. It shows you can handle different types of debt successfully.
Right, diversity is good here too.
It can be, yeah. And the last 10%.
What's that?
That's related to recent credit inquiries, specifically hard inquiries.
Okay, what's a hard inquiry versus a soft one?
Good question. A hard inquiry happens when you actively apply for new credit, a new card, a loan, a mortgage. A soft inquiry is when, say, you check your own credit, or a credit card company checks it to pre-approve you for an offer. Soft inquiries don't hurt your score.
But hard inquiries can.
Applying for a lot of new credit in a short time can temporarily dip your score a bit. So it's generally wise not to go on like an application spree.
Gotcha. Okay, so to kind of bring this home, let's say we have John with a 780 score. pretty good.
Very good score.
What advantages does he have compared to someone maybe with a 620 score?
Oh, big difference. John, with his 780, he's likely getting the absolute best interest rates on things like car loans, mortgages, maybe even those 0% financing deals you see. He'll also qualify for the premium credit cards with great rewards and perks. Over the life of a mortgage or a car loan, those lower rates can save him, honestly, tens of thousands of dollars.
Wow. And the person with the 620?
They're likely facing much higher interest rates. The cost of borrowing is significantly more. They might have fewer loan options or could even have trouble getting approved for certain things. It really is a substantial difference in your financial power.
It's like the VIP lane versus waiting in line.
That's a good way to put it. Financial fast pass.
Okay, wow. That definitely highlights why understanding this is so important. So payment history is number one, but let's circle back to credit utilization, that 30% chunk you called the secret sauce. Why is that one so key?
Well, partly because it's the second biggest factor, but also because it's something you often have like pretty direct and relatively quick control over compared to, say, the length of your history.
Okay, so it's actionable. What is it exactly?
Your credit utilization ratio, or CUR, it's simply the amount of revolving credit you're using, primarily your credit card balances, compared to your total available credit limits on those cards.
Right. And how do we figure that out? Is there a formula?
Yep, pretty simple one. You take the total balance you owe across all your credit cards,
Okay.
divide that number by the sum of all your credit card limits,
Got it.
then multiply by 100 to get a percentage.
Okay, let's do a quick example. Say I have two cards. Card A has a $500 balance and a $2,000 limit. Card B has a $500 balance and a $3,000 limit.
Okay, so your total balance is $500 plus $500, which is $1,000.
Right.
And your total credit limit is $2,000 plus $3,000, which is $5,000.
Makes sense.
So you divide the $1,000 balance by the $5,000 limit. That gives you 0.20.
Okay.
Multiply by 100, and your credit utilization ratio is 20%.
20%. Is that good, bad, average? What's the target we should shoot for?
So generally, keeping it below 30% is considered good. That's kind of the standard advice.
Okay, under 30.
But if you really want to optimize your score, the sweet spot is often under 10%.
Under 10%. Wow, that's low.
It is low, but think about it from the lender's perspective. Someone consistently using less than 10% of their available credit looks like they have their finances well under control. They aren't heavily reliant on borrowing. That signals lower risk.
Okay, under 10% is the gold standard for maximizing that part of the score. Now, you mentioned a practical tip related to this, something about timing.
Yes. This is a really useful thing to note that a lot of people miss. Your credit card issuer typically reports your balance to the credit bureaus only once a month.
Okay.
And that usually happens around your statement closing date, not necessarily your payment due date.
Ah, okay. Statement closing date.
Right. So the trick is, if you can pay down your balance before that statement closing date, the lower balance is what gets reported.
Even if I charge more later in the month.
Even if you use the card heavily during the month, if you bring that balance way down right before the statement closes, your reported utilization will be low, and that can give your score a nice little boost, sometimes pretty quickly.
Huh. That's really clever. So wait, even if I pay my bill in full every single month by the due date, if my balance was high on the statement closing date, that could still hurt my utilization ratio.
Exactly. That's the key insight. Let's say you have a card with a $2,000 limit. You charge $1,500 on it during the month for, groceries, gas, whatever.
Right.
Your statement closes, showing that $1,500 balance. Then, before the due date, you pay the full $1,500. You're being responsible, no interest paid.
Right.
But the balance reported to the bureaus was $1,500 on a $2,000 limit. That's a 75% utilization for that card.
Whoa, even though I paid it off.
Even though you paid it off. That high reported utilization can still weigh down your score. So paying before the statement closes can make a big difference in how lenders see your usage patterns.
That is a really, really important detail. Okay, so we get the score, we get utilization. Now, let's talk about the actual document where all this info lives. The credit report. What is that exactly?
Your credit report is basically the detailed backstory for your credit score. It's a comprehensive record of your borrowing and repayment history.
Like a financial report card.
Exactly like a financial report card. It's maintained by those credit bureaus we mentioned, and it shows lenders how you've handled credit over time.
And what kind of details are actually listed on it?
Well, you'll see your personal info name, address, social security number, that kind of stuff, to identify you.
Okay.
Then a list of all your credit accounts. Credit cards, store cards, car loans, student loans, mortgages. It shows who the lender is, your credit limit or loan amount, the current balance, and crucially, your payment history for each account.
So it shows if you've been on time.
Yes, usually for the last several years. It will also flag any negative marks, things like missed payments, especially those 30-plus days late, accounts sent to collections, any bankruptcies, foreclosures, stuff like that.
Anything else?
Yeah, it also lists those hard inquiries we talked about, the recent applications for new credit.
So it's a pretty complete picture. Why is it so important that we actually look at these reports ourselves?
Oh, critically important for a couple of big reasons. First, errors happen, like more often than you might think.
Really?
Yeah, the Federal Trade Commission, the FTC, did studies showing like 1 in 5 Americans might have an error on at least one of their credit reports.
1 in 5? That's huge.
It is. And these errors can range from, a misspelled name or wrong address to much more serious things like accounts that aren't yours because of identity theft or payments incorrectly reported as late.
Okay, so finding errors is reason 1. What's reason 2?
Reason 2 is that finding and fixing those errors is your responsibility. An error could be dragging down your score without you even knowing it, costing you money through higher interest rates, or preventing you from getting approved for credit you need. Checking your report is the only way to catch these things.
Right. You've got to be proactive. So how do we get our hands on these reports? Do we have to pay?
Nope. Federal law entitles you to one free copy of your credit report from each of the 3 main bureaus, Equifax, Experian, and TransUnion, every 12 months.
Okay, one free, one from each every year. Where do we go?
The only official government-mandated website for this is annualcreditreport.com. Be careful of lookalike sites trying to sell you things. Go straight to annualcreditreport.com.
Annualcreditreport.com.
Got it. Good tip.
Yeah, and a smart strategy is maybe not pulling all 3 at once. You could pull one every 4 months. That way you're kind of monitoring your credit throughout the year.
Oh, that's a neat idea. Stagger them. Can you share, a quick story of someone who actually found something useful by checking? Absolutely. Think of Sarah. She made it a habit, checked her reports yearly. One year, she's looking through her Experian report, let's say, and spots a collection account for a utility bill she's never heard of from a city she never lived in.
Uh-oh.
Yeah. So she investigates, contacts the collection agency, contacts the bureau. Turns out it was for someone with a very similar name and address, classic mistaken identity case.
Okay, so what did she do?
She filed a formal dispute with Experian, providing proof it wasn't her debt. The bureau investigated, confirmed the error,
And removed it.
from her report. And guess what? Her credit score jumped up by about 40 points almost immediately.
Wow, 40 points.
Yeah.
Just from catching one error.
Exactly. It just shows the real, tangible benefit of taking the time to look. Don't assume they're perfect.
That's a really powerful example. Okay, so we keep mentioning the bureaus, Equifax, Experian, TransUnion. Let's clarify their role. Who are these guys and what do they actually do?
Think of them as the big 3 data collectors and keepers for consumer credit information in the U.S.
The gatekeepers.
Kind of, yeah. Their primary job is to collect credit-related information from lenders, banks, credit card companies, mortgage lenders, auto finance companies, even collection agencies and public records.
Okay, they gather all this data.
Then they compile it into your individual credit report. And they also use all that data along with their own scoring models like FICO scores or Vantage scores to calculate your credit scores.
So they compile the report and calculate the score.
Got it.
Now, is the information identical across all 3 bureaus? If I check Equifax, will it be the same as Experian?
Not always, and that's a really important point. While most major national lenders, like big banks and credit card issuers, usually report your account activity to all 3 bureaus,
Okay.
some smaller lenders, like maybe local credit unions or certain retailers, might only report to 1 or 2 of them.
Ah, I see.
So because of that, the information on your Equifax report might be slightly different from your Experian report or your TransUnion report. One might show an account, the others don't, or maybe an error only appears on one report.
Which is another reason to check all 3, not just one.
Exactly. You need the full picture.
And when we apply for, say, a mortgage or a car loan, do lenders pull reports from all 3 or just one?
It really varies. Some lenders, maybe for a smaller loan or a credit card, might just pull from one bureau, perhaps the one they have the strongest relationship with, or the one most commonly used in that geographic area.
Okay.
But for bigger decisions, like a mortgage, it's very common for the lender to pull your reports and scores from all three bureaus to get the most comprehensive view of your creditworthiness before lending you a large sum of money.
Right, they want to cover all their bases. Makes
Mhm.
sense. Okay, this is super helpful. Let's shift gears slightly and tackle some quick, common questions people often have. Ready?
Let's do it. Fire away.
Okay, first one. How many credit cards should I have? Is there, like, a perfect number?
Yeah, we get this one a lot. There's really no magic number, seriously. What matters way more than the number of cards is how responsibly you manage them.
So, quality over quantity.
Totally. Keeping balances low, especially relative to the limits, that utilization thing again, and always paying on time. That's what drives your score. For someone just starting out or rebuilding credit, managing just one or two cards perfectly is way better than having five cards with missed payments or high balances.
Okay, focus on management, not the count. Got it. Next question. Will closing an old credit card hurt my score? Maybe one I don't use anymore.
It potentially can, yes. There are two main reasons.
Okay.
First, when you close a card, you lose its credit limit from your overall available credit calculation.
Ah, right.
So if your balances on other cards stay the same, closing one card can actually increase your overall credit utilization ratio, which could lower your score.
Okay, that makes sense. What's the second reason?
The second reason relates to the length of your credit history. That older card contributes to the average age of all your accounts. Closing it, especially if it's one of your oldest accounts, can shorten your average credit history length, which might also slightly ding your score.
Hmm. So unless there's a good reason, like a really high annual fee you don't want to pay.
Exactly. If there's no compelling reason like a high fee and the account is in good standing, it's often better to just keep it open, maybe use it for a tiny purchase every few months just to keep it active, then pay it right off.
Good advice. Okay, what about missing a payment? If I'm just like a day or two late paying my credit card bill, is that a huge disaster for my score?
Okay, so there are two parts to that. First, the lender might charge you a late fee pretty quickly, sometimes even if you're just a day late, depending on their grace period policy.
Right, the fee. But what about the score impact?
For your credit score, the real damage typically happens when a payment becomes 30 days or more past due. That's usually the threshold when lenders will report the delinquency to the credit bureaus.
So under 30 days late might not show up on the report itself.
Often, it won't be reported as officially delinquent, but, and this is a big but, you absolutely don't want to make a habit of it. Aim for on time every time. Set up auto pay for at least the minimum payment or calendar reminders. Don't risk it. Those late fees add up, and slipping past 30 days is bad news for your score.
Okay, aim for on time, always.
Yeah.
Understood. Last quick question. What if I check my report, like Sarah did, and I find an error, something that's definitely wrong? Can I actually get it fixed?
Yes, absolutely. The Fair Credit Reporting Act, or FCRA, gives you the legal right to dispute any information on your credit report that you believe is inaccurate or incomplete.
Okay, so I have rights here. How do I do it?
You need to file a dispute directly with the credit bureau that's reporting the error. You can usually do this online through their website, or you can send a letter by mail. Certified mail is often recommended for documentation.
And what happens then?
The credit bureau is legally required to investigate your claim, typically within 30 days. They'll check with the source that provided the information, like the lender or collection agency.
And if they find I'm right?
If their investigation confirms the error, they have to correct it or remove it from your report. They also have to notify the other two bureaus if the error correction impacts them. So yes, definitely dispute inaccuracies. It's a crucial tool you have.
That's really good to know. Very empowering. Okay, we've covered a ton of ground here. This has been incredibly helpful. Can we maybe boil it down to a sort of action plan? What are the absolute key takeaways for keeping your credit healthy?
Yeah, let's summarize. A concise action plan first. Check your credit reports regularly, at least once a year from each bureau at annualcreditreport.com.
Check reports. Got it.
Second, watch that credit utilization. Keep it below 30%, but really, aim for under 10% if you can. Pay balances down before the statement closing date.
Utilization under 10%. Okay.
Third, pay bills on time. Every single time. No exceptions if you can help it. Use auto pay, use reminders, whatever it takes. Payment history is king.
Pay on time. Crucial.
Fourth, be mindful about applying for new credit. Avoid opening too many new accounts all at once. Space out applications if you need multiple lines of credit.
Don't go application crazy.
Right. And finally, number 5, dispute errors immediately. If you see something wrong on your report, don't wait. File that dispute with the Bureau right away.
Dispute errors promptly. Excellent. That's a really clear, actionable list. Fantastic advice. Really practical stuff anyone listening can start doing, like today. Remember, everyone, your credit score, it's not just some random number. It really is a vital key.
It unlocks better financial opportunities, better rates, and honestly just gives you more peace of mind.
So true. Start building and nurturing those good credit habits now. It pays off.
And, as you continue on your financial journey, just remember that understanding credit, it's an ongoing thing. Keep learning, keep asking questions.
Absolutely. And speaking of questions, if you have any about credit scores or many other personal finance topics you'd like us to tackle in future deep dives, let us know.
Yeah, reach out. We'd love to hear from you.
You can find our contact info in the show notes or connect on social media. And please make sure you subscribe to the deep dive on whatever app you use for podcasts so you don't miss our next conversation.
We really hope this discussion has demystified credit a bit for you and empowered you to take even greater control of your financial future.
Well said. Until our next deep dive, keep exploring, keep learning, and maybe consider this. Your credit score isn't just about getting loans. It's often seen as a reflection of your overall financial responsibility, and that perception can sometimes open or close doors you might not even expect. Something to think about.